Morning, guys. It's Thursday, May 8th, 5:26 a.m. Central Time. Grain markets are mixed to higher this morning. July corn futures up a half cent at 4.49 and 3/4. July soybeans up 5 1/4 at 10.44 and a half. July Chicago wheat up 4 cents at 5.38 and a quarter. July Kansas City wheat up 4 1/2 at 5.34. July spring wheat up 4 cents at 6.07. The corn market finished lower yesterday after a higher open. Why don't we start there?
So, as you said, the market opened higher on optimism over a potential trade agreement between the US and China. However, the market reversed course with the July 25 contract falling by about 6 cents to settle near 4.49 per bushel. The decline was partially due to President Trump stating that he will not lower tariffs on China as a measure to ease trade negotiations with Beijing. Corn prices also came under pressure as favorable weather is forecast for the Corn Belt over the next 10 days, which is expected to advance planting progress. As of Sunday, planting was ahead of schedule, with corn 40% complete and soybeans 30% complete.
Yesterday in the morning, there was a lot of optimism with the US and China, and there still is that there are meetings forthcoming, but Trump kind of threw cold water on the whole thing. And now I suppose we're back to trading US weather and crop prospects, and also the idea, or I guess fact, that we're going to see some bearish projections from USDA on Monday morning. We've got our monthly crop production and WASDE report in May. USDA gives us their first look at the new crop balance sheets. And the U.S. numbers in particular are almost guaranteed to be bearish, given the high acreage that we saw in the March intentions. They're going to start with the trend line yield. They're going to spit out a carryout projection that's north of 2 billion bushels for new crop, which is they're trying to guess how much corn will be left over on August 31st of next year. So they're just getting started, but it's going to be a bearish look and kind of a sentiment thing. With regard to price action, we are at what could be a very important level on the charts here this morning. This July corn contract had a big low back in August of last year, and there's a trend line that comes up off of that August low through the October of 24 low. That's about where we're sitting this morning. So if you're a bull in the corn market, perhaps you'd like to see the market avoid, or this contract avoid, a close below, call it 448 today. The December corn setup looks very similar. We're sitting on a trend line. There's a trend line that comes off of the December low in this instance through the, I believe it was late March low, and we're sitting right about there today. So you'd probably like to see D's corn avoid a close below 440. Let's get to weather. And before we get to forecasts, let's talk about past weather for a second. I've been accused of neglecting those who have been wet over the last week or so. So let's talk about that. There have been places over the last couple of weeks that have been wet. You look at, call it the Ohio River Valley in particular. Parts of Ohio have been very wet, 4+ inches of rain over the last 7 days. Parts of Indiana, parts of Kentucky, certainly Tennessee, and places further south. There are areas that need to dry out. When I talk about weather as it relates to markets, I tend to do it on a national basis. Like on a national basis, the everything looks pretty good. It's forecast looks open, but there are always problem areas. And if I neglected to discuss these problem areas, I apologize. But yeah, there are some areas that may be delayed a little bit. That being said, I mean, even these problem areas were ahead of schedule with regard to both corn and soybean planting. Ohio and Indiana were both ahead of schedule, ahead of average as of Sunday. If you want to look at the last 14 days, yeah, Ohio saw twice its normal rainfall over the last 14 days. So there are areas that are problematic. Just on a national scale, we're not problematic. To look at weather moving forward, the next 5 days is pretty much wide open for the vast majority of the Corn Belt. I know things are rocking and rolling in real time here. There will be some rains that return to the central part of the Corn Belt, like Illinois and Indiana, parts of Missouri, a little bit of Iowa. This will be like Wednesday, Thursday next week. But to look at the forecast, just about every major corn growing state is going to see below normal rainfall over the next 2 weeks, with the exception of places to the east and southeast, like Kentucky and Tennessee and into North Carolina. Also, North Dakota will be a little bit wetter than normal. But the market's looking at this weather situation and saying it's pretty wide open. The crop's going to be planted quick. Yeah, there are some problem areas, but again, on a national level, we're in pretty good shape.
President Trump has ruled out lowering tariffs on Chinese imports. While speaking at the White House on Wednesday, he said he would not consider reducing the 145% tariff as a gesture to encourage trade negotiations with Beijing. The statement comes just days before U.S. Treasury Secretary Scott Bessent and Trade Representative Jameson Greer are set to meet Chinese officials in Switzerland to ease the ongoing tariff dispute. Beijing strongly opposes Trump's hardline stance heading into the talks, as one would expect. When asked about his expectations for the meeting, Trump responded, "We'll see. We were losing $1 trillion a year. Now we're not losing anything. It's the way I look at it."
There is going to be a trade deal announced today. The United States and the UK reportedly have reached some sort of deal. Is that of impact for the grain markets? Probably not, but the outside markets like it. Stocks are higher this morning. The S&P is up 60 points. The Dow's up 350. The dollar's up a little bit. So we're waiting on U.S.-China. Trump, again, threw cold water on it yesterday, but it's a fluid situation. It could change very quickly.
The podcast industry is proving to be far more lucrative than previously thought. According to research firm Owl and Company, the sector generated $7.3 billion in sales last year, more than double prior estimates. Most of this revenue came from advertising and subscriptions. Live events were not included. While U.S. audio ad revenue alone was estimated at $2.4 billion, the company's report also factored in video platforms like YouTube, which is now the dominant podcast platform. The research further expanded its scope by including podcast audiences in China, particularly on the popular app Ximalaya.
We love independent media, and you guys, if you're watching, apparently also love independent media, and we love you guys for being here. Here's a chart of U.S. media consumption trends. Podcasts overtook print news in 2014, 2015 in terms of consumption in the United States, and it looks inevitable that podcasts will overtake television sometime very, very soon. Radio, interestingly enough, has held together fairly well, but has also trended lower. So if you were to make a bet, and I've made this bet clearly, that this chart continues to trend in the way that it trends, podcasts will eventually overtake TV and also radio at some point in the future. I'm going to turn this into a shameless plug for our premium subscription. We don't make money on this podcast, on the stuff that you guys see on YouTube and listen to on Spotify or Apple. We actually lose a lot of money if you're to consider our podcast business in a vacuum. This is a slide that I had in a premium video where I discussed this exact thing. The only revenue that we have from doing the public stuff is from the ads that YouTube runs. And YouTube runs ads in our videos, whether we sign up for AdSense, which is their paid program, or not. But we make like a couple $1,000s a month off it. The way I calculated it in a vacuum, I lose about $19,000 a month doing the podcast, and I lose north of $250,000 a year doing the podcast. And this is actually, as I mentioned in the video and premium subs, this would be the statistics for a shitty ripoff version of the podcast. If you want the real deal with myself and Mackenzie, you're actually going to lose a lot more money than this. And that is why it is extremely important that you check out the premium subscription, where we have tons of additional content, videos, grain marketing advice, policy advice, crop insurance advice, transition planning advice. These are things that really matter to you. Yesterday, Brian Splitt was on and discussed charts. The video I've got today, important seasonal information as it relates to corn and soybean prices. This one's not out yet. It'll be out at 10 a.m. this morning. You're going to want to watch that. The transition planning videos that we've done with Chris here the last couple of weeks were absolutely fantastic. So guys, if you like what we're doing here, help support the channel, help support the podcast, subscribe to the premium deal. It's not like you don't get anything out of it. Yeah, it's $50 a month. Is it a little pricey? Yeah, maybe it is. But guess what? There's not a whole lot of people that really care about this stuff. So we've got to sell something in order to make this possible. We're never going to make enough money off YouTube AdSense. And even if we did run ads in the podcast, it wouldn't be enough. It's just too small of an audience. So that's why we've got to sell a premium subscription to make all of this work. If you guys are premium subs, we love you. If you're not a premium sub, we also love you, and we would love to have you aboard. You can sign up at standardgrain.com. It's a $50 per month subscription. Give that deal a shot this morning, guys.
Crop traders are seeing profits decline amid growing uncertainty over U.S. trade policy. On Wednesday, Bunge Global South America reported a 40% year-over-year drop in its first quarter earnings, excluding certain items. The company's shares fell nearly 3%, wiping out this year's gains. In addition to the impact of President Trump's tariffs, a lack of clarity on biofuel tax credits has further weighed on earnings. Also on Wednesday, Andersons reported lower than expected first quarter revenue, sending its shares down nearly 10% to their lowest level since 2022. According to Andersons CEO, ongoing trade uncertainty has disrupted normal grain flows and put downward pressure on commodity prices.
Mackenzie, we discussed this before we started taping. Like, why are these companies actually hurting, like in layman's terms? So trade uncertainty. Okay, I think part of it is low commodity prices. I think that their margins do become compressed when prices are low. It's difficult. It's more difficult for these companies to turn a profit. The trade uncertainty thing, I don't get. I know that they've invested some money in biofuels and the whole bet on things like SAF and renewable diesel, and maybe those haven't turned out exactly how they wanted them to. In any case, Bunge is down 2.5% year to date. It's down 28% over the last year, so not necessarily great. The Andersons looks much worse, down 22% year to date, down 40% over the last year. We had a similar story about, was it ADM yesterday?
Yep.
It seems like all these commercials are just having problems right now.
Corteva exceeded first quarter profit expectations driven by higher seed prices. The agricultural chemical and seed company reported a 13% year over year increase in core profit, reaching $842 million and surpassing Wall Street estimates. Seed prices rose 3% across most regions, with North America leading the gains. The company's total sales, however, declined 2% to 4.4 billion due to weaker demand in key markets, including Europe, Asia, and Latin America. Net sales in both the seed and crop protection segments declined 2%, largely due to unfavorable currency effects. Corteva expects this year's net sales to fall between $17.2 and $17.6 billion, although that forecast does not factor in potential impacts from tariffs.
Corteva is pioneer to many of you guys. In any case, their stock has acted very well. So the seed dealers are doing just fine, up almost 10% year to date. I believe that would be outperforming the broader stock market, up 10% over the last year. So they have clearly been able to translate the inflation situation. They've probably had to raise, things like wages and all that, but they've been able to stay profitable.
U.S. ethanol production declined last week, but remains strong. Weekly output of 1.02 million barrels per day was down 2% on the week, but up 5.7% versus the same week last year. Ethanol stocks were pegged at 25.2 million barrels. The print was down 1% compared to the previous week, but up 4.1% compared to the same week last year. According to Reuters data, U.S. ethanol production margins have firmed in recent weeks, with the most favorable margins being reported in the Eastern Corn Belt.
Production is fine. Seasonally, that's like the third best print of the last 10 years. So there's nothing wrong here. Ethanol stocks drawing down. They're still higher than maybe I'd like them to be, but you're seeing your normal seasonal drawdown, which is what we expected. But it's good that we're not seeing the opposite. And some sort of contra seasonal run up would be phenomenally negative. So all is good here, and this is a bright spot for corn demand.
The Federal Reserve kept interest rates unchanged at 4.3% on Wednesday. This decision comes despite mounting pressure from President Trump to cut rates. The Fed now faces rising risks of both higher unemployment and higher inflation, a rare combination that could signal stagflation. According to Fed Chair Jerome Powell, Trump's sweeping tariffs have increased economic uncertainty and weakened consumer and business sentiment. He emphasized that the Fed is in no hurry to cut rates. While many analysts initially predicted 2 or 3 rate cuts this year, economists still expect at least one rate cut before the end of the year.
So the Fed's job largely is to look 4 or 5 steps forward and try to anticipate what's going to happen with the economy. I would not want Jerome Powell's job right now, given the uncertainty with the tariffs. I mean, it's one way one day and a different way the next day. How are you supposed to? I mean, this is an impossible job as it is, but in this environment, it's especially difficult. The stagflation risk is something people talk about. I don't know how real it is. I guess it depends on which way we end up going with these trade wars. What did cattle do yesterday?
Cattle futures were lower. Live cattle were 2 cents to $1.15 lower. Feeders saw losses ranging from 40 cents down to $1.25. Box beef was higher. Choice was up 148 at 346.15, and select was up 103 at 334.
Outside markets, I mentioned the stock market is higher. I think this is partially on news or pending news that the U.S. and the U.K. have reached some sort of trade deal. The Dow's up 350, the S&P's up 60 points. Bonds are off a little bit. U.S. dollar's higher. Crude oil is up 71 cents in the June WTI at 58.78. Have a great day, guys. We'll be back on Friday.